Assalamualaikum warahmatullahi wabarakatuh and hi. Today we are going to talk about short selling, which will be discussed by Zasnita and Nabila Amira, students of Bachelor of Mathematical Sciences from IIUM.
First of all, we will see the content of this video. First, we will discuss about the definition of short selling. Then, we will continue with the strategy involved for this short selling with an example. And lastly, we will close with the risk management involving short selling. So, what is short selling? By definition, short selling is an investment or trading strategy that speculates on the decline in stock. It involves selling the stock that are not owned by the investor. Investor can maintain the short position as long as desired, but they still need to replace back the stock they borrowed to the original owner. The question is, what will be the strategy used involving this short selling? Let's look into it with an example. For example, you as an investor receive a speculation that the price of a company A will go down or will lose its value in the future, and you want to make a profit out of it. So, as an investor, you will instruct the broker to borrow some stock from others to do short selling. Let's say you borrow 500 shares and sell the shares immediately when the price is $120 each. Your money worth will be $60,000. Then when the stock price falls, let's say it falls to $60 each, you will buy back the 500 shares that worth $30,000 at the moment. Then you as an investor return back the shares you borrowed to the original owner while you keep the profit worth $30,000 from the changes in price. Do you think short selling is easy and this simple? The answer is no. There is risk that you need to know when you want to do short selling. What if the price of share rise instead of fall? When this happens, the investor will need to buy the shares in a higher price. It can make the investor lose an infinite amount of money. So now we will discuss the risk management and the requirement before we do short selling. To do short selling, investors are required to have margin account. They are required to have an initial margin. It is the amount of money deposited before they can do short selling. Investors also required to have maintenance margin. This is the amount of money needed to maintain the account. Why we need this margin account? Margin account is important to cover the risk of loss in case the investors are not able to return back the borrowed shares.
To conclude this video, short selling is a concept where you do not have any asset. Thus, you borrow some asset from others and manipulated the asset to gain some profit. That is all from us. Thank you for watching.